What's up, everyone? It's Karthik with Money Vest. So markets had a little bit of a rebound on the day today. So that's good to see that we did see nice volatility crush on the day. I spent a lot of time sending out updates and alerts over on our Discord. But there is one thing that really pisses me off. Like, there's one thing that gets my blood boiling and it frustrates me to my core when I see headlines like these. Institutional investors bought the dip, retail traders sold aggressively. So retail traders or investors were aggressive net sellers on Monday following the sharp equities pullback, with most of the selling occurring in the first hour of trading. This was a note from JP Morgan, and retail order imbalance ended the day at negative $1 billion, which is about negative 0.25 standard deviations below the 12-month average, and inflows into ETFs for $472 million, but that were far outweighed by the outflows on individual stocks worth over $1.4 billion. And guess who actually bought this dip? It was very carefully curated. It was very carefully engineered by institutional investors, by Wall Street, by big money, which bought the dip with $14 billion of net buying from institutional investors. Folks, do me a favor, please share this video, share our channel with other long-term retail investors, because it absolutely hurts me when I see people selling in the best possible time and they're actually getting out of the market. And who's taking advantage? Institutions. And I mentioned this in my previous videos as well, is that when you take a look at institutional investors and when you look at hedge funds, right? When you look at pension funds, big money managers, asset allocators, you look at them, they've got a clock running every year. They've got to beat the S&P 500. They've got to beat the S&P 500 so that they can create very nice looking investor presentations, letting everybody know and letting their clients know that we beat the S&P 500, so they can get more assets under management, charge more fees, generate more revenues for themselves, more commissions for managing the assets of multiple investors, hundreds of millions of dollars, billions of dollars. And that's why it is so important for them to constantly continue to manage assets in a way that they are buying and selling. And of course, they're trying to engineer these types of sell-offs in the market so prices come down and they're able to buy these dips, because we really did squeeze the market very high. Like in terms of the technology stocks that were pushing up, individual indices, individual stocks that were pushing higher, we did squeeze the markets to the max level here to milk out as much profit as we could. And then as they were at an all-time high, Wall Street needed to engineer some type of sell-off for it to come down so that they can start buying that dip again. Because as I mentioned before, price determines your future returns. Price paid determines your future returns. Whether you make money or you lose money depends very much on the price paid. So please do me a favor. Do not make the mistake of selling stocks at lower levels when prices are selling off. Don't make the mistake of selling in panic or out of fear and getting out of the market. So try to avoid those types of situations. Share these videos, share our channel with other investors who can, understand the market structure, the dynamics a little bit better. I deployed capital yesterday. I mentioned this in our community as well. I essentially mentioned that, volatility here down a little bit over 62%. From yesterday's peak. It's down 37% today. As I've said before, patience and if patience in the markets will give you opportunities to buy. Understand this concept and you have a winning strategy. Hope everyone is doing well on everything they picked up yesterday. And I also mentioned that you should pat yourself on the back. If you bought somewhere between 8:30 a.m. Eastern and 10 a.m. Eastern during that entire peak in the volatility over 65, pat yourself in the back right now and let us know in the comment section down below if you actually bought yesterday. If you bought yesterday, let me know in the comment section down below, because I picked up $15,000 worth of stocks and ETFs. I should have bought more because that was quite a rare event in volatility as we were hitting over 65 in the VIX. But if you did buy somewhere between 8:30 and 10 a.m. Eastern yesterday, let us know in the comment section down below, and also pat yourself in the back because you were able to capture one of the most rare occurrences in volatility in the history of this chart, recording third highest level at over 65 in the VIX. I also mentioned that we're not completely out of the woods yet, but it's a start. It is, however, unusual for the VIX to spike again after getting crushed over 62% in 24 hours. It's not impossible, so be ready at all times. So what I meant by that is that volatility, of course, all the way from 65 came down to as much as 24. So just in a matter of 24 hours, volatility has been crushed over 60% back to 24, 25 levels. So it's quite unusual for us to see another spike. Though not possible, it is a very low probability outcome. And this right here is during the pandemic, during the 2020 sell-off in the markets. And what we experienced back then was volatility getting up to over 65. The last time was back during the COVID crash of 2020. And we spent a total of 8 days of over 60 before crashing down to 25. And the VIX came down over the course of 49 days. So this analysis essentially shows us that we got up to over 65. We spent 8 days above 65. So somewhere between 65 and 85. 85 was the high that we hit during the pandemic and during COVID. So that was the highest level. And we spent 8 days over here at those higher levels. And then it took us over 49 days to actually come down to as low as 24 and 25. This time around, we spiked to 65, crushed back down to 24 within 1 day. So we spent 1 day over 65, not even 1 day, not even one full day. We spent about a few hours over 65 because I think yesterday we already did close down to like 40s. And then, of course, coming down to 24, 25 now. So can the VIX see another spike of 100+%? Sure, anything is possible, but the probability is low unless the carry trade worsens, triggers more margin calls, liquidates more accounts, recession fears continue to grow. Something to think about as well. But the idea here is always going to be that when the market gives us the opportunity, take advantage. Don't sell out of fear. Don't sell out of panic, but instead do the opposite. It's very much taking advantage of when there is fear and panic in the markets. What you do during those times is your edge. Your edge can be something as simple as keeping your calm, keeping your composure, keeping your patience, keeping your discipline, keeping your emotions aside. It can be something as simple as that. And I know it sounds easier than done, easier said than done, but that's why we're here. That's why we've got a community of over thousands of people that are from all over the world coming together to help support each other and provide unparalleled analysis and understanding of the markets so that you've got someone in your corner, right? We're not institutional investors. We're not trying to steal capital away from you or the next person, right? We're here together investing our own money, and we're here to support each other, provide our best analysis, share perspective, share experiences, share mistakes, so that you've got somebody in your corner looking out for your best interest as well. So if you want, again, link's going to be down below. We'd love to have you on board. I've opened up a few more spots with 16% annual discount that's available until the end of this month. I'm sure you're going to find a lot of value there. I do share a lot of analysis and updates over on Discord in real time. So I answer all the questions on Discord so you can get my real-time analysis during market open over there as well. So if you want to join, link's going to be down below. We'd love to have you on board. So this right here is from Charlie Belio. He also likes to do some very, very nice, cool data-driven analysis, so shout out to him. And this right here is essentially highlighting the very fact that the 136% spike in volatility in the last 3 trading days, this is the third largest 3-day percentage increase in history. That's exactly what I also mentioned in Discord. So I mentioned pat yourself in the back if you were able to take advantage of when the VIX was as high as 65 and recorded the third largest increase in history. And here's a look back at the top 20 3-day volatility spikes and how the S&P 500 fared going forward. So these are the forward S&P 500 total returns after we witnessed a volatility spike. So 2018, 2015, and 2024, the starting point, ending point, and the percentage change in volatility. And when we have seen over 100% increase in the VIX, which has happened many times over, we have seen 1 year, 2 year, 3 year, 4 year, and 5 year returns to be extremely positive, folks. We have seen the markets green across all metrics here: 1 year, 2 year, 3 year, 4 year, 5 year, post increase on a 3-day basis for volatility of over 100%. The markets have been extremely profitable with 5 year 68%, 104%, 66%, 117%, 95%, 108%, 9%. We've just seen an incredible returns for the markets, and these are 2020. So as you can see that some levels are from 2020. That's why we don't have a 5-year return because 5 years not over yet. So 5 year, that's going to populate in 2025. And some of these numbers as well. So 2021 also going to populate in 2026, because 2021 plus 5 years, 2026, and also 4 years is going to be 2025. So those numbers are going to populate. But the idea here is that when the VIX does spike, it has by far been the best buying opportunity in the market. So that's why we keep track of that so closely, right? And I'm going to be including that on our platform as well. So that's going to be available on our MoneyVest platform eventually. There's going to be another section called Volatility, and you're going to have a full breakdown of the VIX, the current reading, the current percentiles, and where we are with the overall market structure and whether there is opportunity to buy, sell, hold. All of that is going to be available on our MoneyVest platform very soon, which again you can take advantage of with the link down below. If you come over to the VIX summary, this is the spreadsheet that we are going to make available, and right now we're back in the normal zone for the VIX. We are now in the 87-88 percentile for volatility again, trading down to as low as 27.7. So we're back in the 80th percentile, and this is once again a bit of a normal occurrence for the market because we have pretty much spent over 38% of the times, somewhere between 20 and 30 for the volatility. So we're back in the normal zone for the VIX once again. So Dow Jones, S&P 500, and the NASDAQ all pushing higher, anywhere from 1% to as much as 76 basis points. And coming over to the gain on the day, so just a little bit over $4,700 gain on the day. I did pick up, FNGU quite aggressively yesterday. I wanted to pick up more, so I will continue to dollar cost average a little bit further into that leveraged ETF. That's a swing trade that I am taking on right now. But this right here is the heat map. So everything green. Most of the stocks were rebounding well, with Apple slightly down almost 1%, AMD down a little bit over 3.4%, Johnson & Johnson, Merck, ExxonMobil, Chevron, Pepsi, slightly down, small pockets within the market that were selling off, but for the most part, everything was green. And this right here was actually the ETFs. And we did see, again, a lot of bullish momentum across the board for equities. The bond market selling off a little bit, so TMF, TLT were down 6 to 2% respectively, and we did have a lot of liquidity flood into crypto, so crypto ETFs, GBTC, FBTC, IBIT, so all of them crypto ETFs pushing higher, with SMH up almost 2%. We had SPY, QQQs, Dow Jones, IWM, VOO, XLK, SOXL, semiconductors, chip stocks, technology, everything pushing higher, small caps, everything was ripping on the day here, as we did get a little bit of a technical rebound. So all 11 sectors in the S&P 500 were green, anywhere between 0.5% to as much as 2%. In the last 1 week, of course, we're still down quite brutally, with utilities the only sector that is actually doing well. This right here was posted by Genevieve on Twitter. These are all the layoffs that have been announced in 2024. So there's been a lot of companies, right? So we got Dell, we got Intel, we got Intuit, we got PayPal, Unity Software, Twitch, Bumble, Expedia, we got Cisco, we got DocuSign, we got Snap, we got Riot Games, Wayfair, Indeed, Peloton, Tesla, Pixar, Discord, Lucid, we got Brex, Wayfair, Duolingo, and we got eBay. So a lot of very notable companies cutting their employees, cutting their headcount by 6, 10, 12, 15, 30, 35%. That's a really high number. So right now we are seeing a lot of notable companies lay people off, and that's obviously creating a lot of fear around recessions in the US economy as unemployment numbers continue to accelerate. And the interesting thing is that we actually did see technology, information technology being one of the sectors where there was a lot of layoffs, and a lot of the manufacturing jobs also coming off. Construction workers are still strong. However, there's a lot of jobs being created in the government sector, not in the private sector. Private companies are certainly laying people off right now, and there's a lot of fears around that accelerated levels of unemployment, thereby increasing the probability of more rate hikes. In fact, even emergency rate cuts are being priced into the market now. But I do believe that that's not going to happen. I think the Federal Reserve and Chairman Jerome Powell is not in that state at the moment to create an emergency environment or create a chaotic environment where they need to cut interest rates ASAP. I think the markets are still within the context of a dip or a pullback. So if you come over to our MoneyVest platform in the market snapshot section, this will give you a very brief idea and an understanding of where we are for individual stocks and for market indices. So for example, S&P 500 still in a pullback, right? Down almost 8% from all-time highs. NASDAQ in a correction of just over 12%, and the Dow Jones just under 6% from all-time highs and in a little bit of a pullback as well. So I do strongly believe that there is a lot of just unnecessary fear and panic in the markets. I mean, if you really think about it, just objectively, okay? Just level with me here. If you're watching this video, I'm sure you are incredibly smart and understanding of what's going on here. And level with me. S&P 500 is down less than 8% from all-time highs. It's in a pullback. NASDAQ is just over 12% down from its all-time highs. It's in a correction. The Dow Jones is less than 6% down from its all-time highs. It's in a pullback. So that's your equity market. Let's take a look at the economy. The GDP is actually growing still at 1.5%, 2.5%, 3% every single quarter. That is a very respectable and a very strong growth rate. Let's take a look at unemployment. 4.3% is where we are on unemployment, right? Historically, that is still a really, really low number, okay? So you've got unemployment, which is, again, at a historically low number, economic growth that continues to be strong, earnings for these companies that have been reporting are coming in very strong, and you've got the markets within the context of a pullback and a correction. I mean, it's not like we're seeing the sky falling apart and a crazy sell-off in the markets. It's a very normal 7 to 12% pullback and a correction, something that we've seen a million times over. And yet there's people banging on the table asking for rate cuts in the tune of 75 basis points. And I'm like, what the heck is going on? Like, this is probably what Jerome Powell is also thinking about. I'm not defending him to a point where, he should not be cutting rates. Like, I think rate cuts should happen sometime in 2024, but it's not getting to a point where there is a panic where they need to come out and start doing an emergency cut of 75 basis points. So I do strongly disagree with Jeremy Siegel. I do strongly disagree with Cathie Wood. I do strongly disagree with anybody who's saying the sky is falling apart and there is an emergency rate cut needed from the Federal Reserve. The situation, at least on the surface level, continues to be somewhat contained. Yes, there is definitely a lot of catalysts and something that we need to account for, whether it's the carry away trade from Japan, the currency crisis, the margin calls that are coming in, and accounts getting liquidated, but then also there's recession fears. But those are all fears. Recession fears are fears for something that hasn't even happened yet. It is accelerating, no doubt. We have to take a look at the trend, but this still doesn't give the Fed a reason to come out with an emergency cut of 75 basis points, right? I mean, we're still very much in the context of a very reasonable and a common pullback and a correction, which is only good news for investors like ourselves, so that we can take advantage of these opportunities and don't be one of those retail traders and investors who's selling on the way down. Be like the institutional investors, be like the smart money who's actually taking advantage of these selling pressure, the sell-off, and you're actually buying. So Bank of America says sell stocks on first rate cut as recession risks rise. Great. Michael Hartnett advises selling stocks at the first Federal Reserve rate cut. Analysis of past rate cutting cycles shows the stocks fall during hard landing cuts here, and recession risks have been underappreciated by investors. And Bank of America isn't very optimistic about the future of the U.S. economy and the stock market. In an August 1st note to clients, the bank's top global strategist urged investors to sell stocks when the Federal Reserve issues its first rate cut. He believes the central bank will be slashing rates into a hard landing scenario for the economy. Okay, so the key word here is soft landing versus hard landing. And we already know this. If there is a crisis, if there is a recession, and if there is a hard landing, and the Federal Reserve starts cutting interest rates on the back of a hard landing, then there is recession already. on the horizon, and that is obviously going to create lower productivity and not so great earnings in future quarters. And that's why it's justified for the markets to sell off. It's justified for the markets to drop on the back of not the first rate cut. The first rate cut is not the reason why stocks drop. The reason is a recession. So it's the chain of events. A recession creates the rate cut, which creates the stocks dropping aggressively because they're anticipating the economy worsening, thereby earnings also coming down. So that's what the markets are looking at because they are forward looking. They're looking for the next 6 to 12 months signals from the economy and the earnings, and that's what they price in very, very quickly. So the rate cut in itself is not a bearish signal. Rate cut in itself from the monetary policy is a quantitative easing measure that they are now instilling to the economy to create more borrowing and starting to stimulate the economy and the economic growth here. So that in itself is not a bearish or a sell signal. It's why they're doing it. What is the reason why they're cutting interest rates? And if that reason is a recession, then yes, stocks are susceptible to a bigger drop. But if there's no recession, if there's a soft landing, then of course, there is opportunity in the markets because that's going to create more momentum to the upside. Hartnett and his team studied the last 12 rate cutting cycles going back 1970s and identified 3 varieties of rate cuts. One is the Fed panics from a financial crisis of some sort. Another is the Federal Reserve cuts into a soft landing with no recession. And the third is cutting into a hard landing with a recession. In the first 2 scenarios, the S&P 500 has risen on average over the following 3 to 6 months periods. So as I mentioned, if the Federal Reserve is cutting interest rates to support a soft landing with no recession, the S&P actually tends to do well. But when the Federal Reserve cuts into a hard landing, which is a recession, right? Stocks have fallen by over 6% in the 3 months following the first cut and 3% over 6 months. So we say sell the first cut. So I feel like that needs a little bit more context, right? If you just read it, sell the first cut, then that is not giving you a lot of perspective. Sell the first cut if there is accompanied with a recession. Okay, I think that it has to be coming in with a huge asterisk around it that sell the first cut only if that is accompanied with a recession. If there's no recession, markets actually go up. Market tends to go up. The analysis showed the hard landing cuts occurred in 2007, 2001, 1989, 1981, 1980, 1974, and 1973. Hartnett said that surging global central bank rate cuts are signs that the economy is in for a rough stretch, and this tends to occur when the economy is in trouble. So these are the rate cuts that we've experienced from central banks over in the U.S. And again, according to their analysis, they've broken it down into 3 different scenarios. And the only scenario where the markets actually drop are the times when the rate cuts are accompanied with a recession and economic growth is slowing down and, of course, coming down. So moving forward, this right here is where we are on the S&P and the NASDAQ. And I want to be very, very clear for everybody watching this video. And I don't want there to be any confusion whatsoever. What we track are a lot of things, including volatility, which has come down to 27.28. The MoneyVest index, which is now trading down to 3. So there is buying opportunity. There's risk reward getting much better. And of course, 3-4 going to be the S&P 500 and the NASDAQ, the overall technical trend for the market. So what I can tell you right now is that the trend is very clear. We are still in the context of a downtrend. We're still making lower highs and lower lows. I want to be very clear that we're not out of the woods just yet. Do not take the bait of falling into this trap to go all in. We're not going all in. I'm not going all in. I've got dry powder ready, waiting on the sidelines, and I'm ready to deploy if and when there's more opportunities and there's better risk-reward ratios. Plain and simple. I do not want there to be any confusion, and I want to be as clear as possible. Right now, I'm nibbling into the markets here, slowly and steadily deploying cash, and we're still within the context of a downtrend. We're not out of the woods, so don't take the bait of the markets pushing higher and deploying all the possible cash that you have available, because we're still in the context of this downtrend here. Support level is going to stay put at 5,100. So that's the level that we bounced off of yesterday, pre-market. When we opened, we were at that 5,100 level. And then since, we have, of course, ripped a little bit over 3.6, 3.7%. But towards the end, we actually did sell off a little bit. So last hour of the day today, we did see some pullbacks for the S&P and the NASDAQ. So we are, again, coming up to this lower high as we discussed. So we did make a lower high. and there is possibility for us to see a new lower low as well. If we continue to slide lower, there is possibility for us to see the S&P 500 at a lower level, which is only going to once again create better risk-reward ratios for us and better opportunities for us. Coming over to the NASDAQ, so QQQs more specifically, you'll notice a very similar pattern where it continues to trade inside this downtrending channel, lower highs and lower lows. And you'll notice that we did get a little bit of a rebound from that lower low. And as discussed, this was the exact resistance we were talking, and then we got rejected here towards the last hour of the day, and of course sold right back down, and support level is going to stay put inside this green rectangle now at around 420s once again. So again, just keep a close eye on these levels as they are incredibly important, and if we continue to slide lower, that's going to create, like I said, better risk-reward ratios, better opportunities for us to buy. The Money Vest Index slid all the way down to 3. And again, the lowest we came down to was around 2.7 or no, 2.8 or something, 2.85 I think was the lowest number that we got down to. And we've come from all the way to over 4.2 to 2.8. So that is quite a significant drop in the Money Vest Index after accounting for a lot of metrics. And again, the lower it gets, the better the opportunities, the more I'm going to dial up on that aggressiveness when it comes to buying into the markets. So it really is an idea of being very, very smart about deploying capital and being also very selective with deploying capital. And that's where a lot of our analysis on the spreadsheets, on the data-driven analysis that we like to do comes in handy, because then you can start to better understand historical data, statistics, and probabilities. I think that's very, very important. So definitely do check out some of those videos, because it's going to give you a lot of perspective on S&P 500, on Magnificent 7 companies, on historical trends and averages and historical returns, the pyramid, the bell curve, everything is covered in our previous update. So I highly, highly recommend you checking out those videos. So coming over to individual stocks, starting with Apple, what you'll notice is that Apple here got bought up yesterday very, very nicely. And also on the day, we are down about 1%. After hours, we're down another 1% for Apple. So support level is going to stay put down to as $197 to as much as $200. And again, we've got a resistance here at a near term sitting roughly at $206 to as much as $215 per share for Apple that we need to watch. Our size come down to almost oversold levels, including the MACD and the L3 banker oscillator as well. So those are some key levels to keep in mind for Apple from a support at 197. Talking about Amazon, and Amazon here also dropping quite aggressively, of course, yesterday down a little bit over 4%. Today up over 0.5%, but after hours down almost 1%. So futures are most likely not going to be looking super good for the market, and resistance stays put right over here at 166 for Amazon, with a support level that's going to stay put down at 144, 145 for Amazon moving forward. Talking about Tesla, and Tesla here also selling off after hours, down a little bit over 1.8%. Resistance is going to be all the way up to $208, and we are now inside this green rectangle once again, sitting in the 190s and 180s. That's going to be that support level to watch for Tesla moving forward. Talking about NVIDIA here, and NVIDIA down over 2% after hours. So there definitely seems to be a bit of an after hours bloodbath here in the markets as we continue to slide lower, with support levels staying put at $96 a share as we continue to come down quite aggressively. Of course, NVIDIA trading back over $100 a share. At one point, it was down over 30% from its all-time highs, but that's going to be that next support level to watch for NVIDIA moving forward. Talking a little bit about Meta platforms, and Meta here. Meta is probably one of the only companies among Magnificent 7 and the entire market that's kind of held up really well. I mean, it is just under $500 at the moment, and was up almost 4% today. After hours, it is down a little bit over 1%, but support level is going to stay put down to as low as 459, 460s, with a massive resistance all the way up to 540, and we've got another support at 420 for Meta moving forward. Talking about Netflix, and Netflix here, also coming down slowly and steadily, down about 77 basis points after hours. This right here has been the overall trend, with support levels going to stay put at $596, closer to $600 for Netflix at the moment, and resistance all the way up to $636 to as much as $652 for Netflix moving forward. PayPal surprisingly doing well, up over 3.7%. So next resistance all the way up to $65 to as much as this triple top, quadruple top, to as much as $68 a share for that target, for that resistance for PayPal. and all the way down to $57 is going to be that support to watch for this company. Visa continues to be in this downtrend of lower highs and lower lows. Support level is going to stay put right over here at $253 for Visa, with a very strong resistance all the way up to $266 for the company, and we're still very much in the context of this downtrend for Visa at the moment as well. Talking a little bit about Google, coming over to some other Magnificent 7 companies. So Google here continues to slide lower. Google, I believe, that is one of those companies that has a ton of potential right now, given that it is down double digits, a little bit over 12 to 13%, actually almost 18%, very close to a bear market Google is. So you can see that it's down almost 17% from all-time highs in a correction still, along with Microsoft that is also down over 14%. From its all-time highs. Meta is the only one that is, again, in a pullback right now among the Magnificent 7. It's actually quite crazy that it's held up better than that of Apple, which is down over 12.5% from its all-time highs. Now, when it comes to Google, support level is going to stay put right here at $153. So that right there is going to be that support level next to watch for Google, but very, very oversold on the R side, the MACD, and the L3 banker oscillator as well. Coming over to Microsoft, and Microsoft on the day here up over 1%, but after hours it is down almost 90 basis points right now, and support level is going to stay put right over here at $400. Very, very strong area of demand, and resistance all the way up to $432 for Microsoft as well. So a lot of consolidation sideways. So those right there are going to be some levels to keep in mind, but very similar to Google and Apple, very, very oversold, with the RSI at just over 29. MACD's been selling off, and the L3 banker oscillator also down quite aggressively. So there is opportunities. I mean, there are oversold conditions for a lot of these Magnificent 7, very, very high quality companies at the moment. So definitely do take advantage if you have ever wanted to own these companies for the long term. Enphase continues to consolidate sideways. So support level is going to stay put here inside this green rectangle at $97, $96, with a massive resistance at $137, $140 for Enphase, and then just a lot of consolidation sideways for Enphase moving forward. So that right there is going to be that area of consolidation to watch for this company. And then finally, we come over to Costco, which is also just consolidating sideways a little bit, up over 1.8, almost 2% on the day today. So had a pretty decent day. Resistance all the way up to $838, with a support level that's staying put at $785 at the moment. So hope you all enjoyed this video and a complete update on the markets. Couple things to note here. Please do not operate as other retail investors, and don't sell out of panic or fear when the markets are actually selling off and they are in this state of chaos and panic. Those are the best times to actually take advantage of those opportunities. Keep a track of the volatility, keep a track of the S&P 500 NASDAQ levels. We're still within the context of a downtrend, lower highs and lower lows, so we're not out of the woods yet. I'm slowly and steadily dollar cost averaging a little bit, nibbling in with a little bit of cash and keeping majority of my dry powder ready for when situation, if and when it actually starts to get much worse than where we are now. Keeping track of course, the MoneyVest index as well. So links can be down below if you want to join and be a part of our MoneyVest community. We'd love to have you on board. If you have any questions, please feel free to reach out. And as always, happy investing. I'll see you all in the next video.